Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. Having initially reached the downside call of 65.50 last week, the Australian dollar has managed to stabilise as it wraps up the week on a positive note as the US dollar index, which measures the greenback strength against a basket of 6 major currencies, slips beneath the 102 handle. This was all on the back of the key event, which showed a weaker than expected US job report. According to the US Bureau of Labor Statistics, the BLS, the non-farm payrolls added 187,000 jobs in July, which missed the 205,000 forecast. Meanwhile, the release in June was revised down from 209,000 jobs to 185,000. This gave the market a little bit of a slight jitter as the dollar sold off. But the unemployment rate falling a notch from 3.6% to 3.5%, while the average hourly earnings increased 4.4% year on year in July, unchanged from the previous month and slightly above forecast. Looking at the Australian dollar, it is a little bit mixed when it comes to the direction. Nevertheless, I feel that establishing its base around that 65, 40, 50 area, the 2 days of bullishness may come into a little bit of problem when it gets closer towards that 60-cent region, and therefore could see a retreat and look back towards the downside due to the fact is that the technicals are weak and the MACD is very heavy. So therefore a small impulse up and then expect to see another down test. Looking ahead to the economic data this week is a little bit light to the calendar, with the US and China both updating their CPI and PPI data, which will or could cause much volatility across the board. Looking at the euro, well, the market has also found initial momentum as the dollar weakened. Now, the dollar index got to around 102.50 last week and now drops to around the 101.70 area. In light of that, the euro has pushed higher and now getting closer towards its objective, as I felt the market would be a little bit of a squeeze on Friday. So therefore 110.45.55 is eyed and may find a little bit of a struggle to uphold if we get there. Overall though, I feel the market might reject there and eventually head back towards the bottom side, somewhere around 109 down to 107.80. From the numbers of the non-farm payrolls, traders are expected to view the Fed may keep rates on hold at their next meeting in September. After last month, the US Central Bank raised its rates by 25 base points to 5.25 to 5.5 and signaled a wait and see approach for any further tightening. The dollar yen market was somewhat heavier, and now since the engulfing candle didn't quite get that confirmation to support the candle to a bearish case of 141.65. However, I'm taking it on board that the fact is that the technicals are getting somewhat heavy and we could see a weaker start to this week, and that is see a move down towards 141.20, maybe even lower to the low 140 area where I've outlined here. Don't get too bearish though, because the market's likely to stage like it previously. I feel the 4 days of strength can still find the market relatively bullish as we get closer to the lowest side of the range of 140 and maybe even see a surge back to the top side anywhere towards 143 to 145. After last week's dovish rate hike from the Bank of England, the market's still a little bit somewhat mixed when it comes to the pound. However, to get a bullish call, there is a lot of work to be done. First of all, the fact is we've got to break above this broad trend line, which is now serving as a resistance, which is seen around 127.60-70. And then we've got to break this downtrend, which is seen around 128.20. Break above there, then yes, I would feel that the market is in track. That is to see a rally up towards 130. But wait for the break, because if we don't get it, the market could actually reverse and look back towards the low region after posting an intraday low of 126.20 last week, maybe even going lower towards 125. An engulfing candles come back for gold and now gives some question whether the market is strengthening up. Well, we do need to see a confirmation to this candle, and a move above 1,947 will give further scope up towards 1,960 to 62. But the broader range is still bearish in my view. And the fact is the market may actually find anywhere above 47 tricky to or even find sustaining, and therefore towards this level anywhere around 1960, and then plummet back towards the lows that we saw last week, anywhere from 1915 to 1925. It seems that after breaking back above the trend line, oil is back on track, that is towards the challenge of $83.40.50. Reassess from there. There is a bit of divergence here, so I'm not going to get too excited, as the market's been in a relatively broad uptrend since these lows that come in around $67 a barrel. Traveled quite a long way, and I feel the market is quite heavily long, meaning that many participants have been buying this rally all the way and little profit taking when you count the candles in terms of the red. Fact is, I feel the market may take another topside challenge and reject anywhere from 83.5 and look back towards somewhere around $77.50. Well, that's a wrap to the start of the week. Thank you very much for joining me, and as always, look out for the intraday report, and I hope you enjoy the great day ahead.